All right, Yield Nerds, episode 134. I have a very interesting topic. At least I learned a lot doing the research on this topic, suggested by one of our viewers who made a comment saying, "Hey, have you looked at this real estate investment trust? It is as good as any bond out there." And I got very excited. I dug in deep and I'm sharing my analysis with you. Remember to do your own research. We're at 360 something subscribers. Thank you for your support. If you're new, please use the Income Investing Roadmap, which is a playlist. It starts from a beginner level for a fixed income investor up to this one and more. Most importantly, I do not have any magical powers of prediction, so please make sure you check my work and do your own research. Well, the agenda for today is to first monitor the market temperature, as I always do, and I'll share my general thesis of REITs, and then we'll go dig into where REITs are in 2024, how have they performed, and where are they likely to go. And based on that, I will inform my own trades and I'll share them with you. The wheels are turning in my portfolio. I'm at 6.5 something percent for the last year. I'm happy about that. It pays for my annual expenses on top of that 6.5%, and most of it is state tax free. So overall, it works out well. Thank you, and I'm happy with where it is now. I could always look at the other side of the river and say, boy, if I had put everything on the S&P, I'd be up 25%, and I could easily sell 6.5% of my assets and use that as the return. Why am I not doing that? And maybe I should. So I'm going to educate myself on that as well. My portfolio, if you are new, you will note that I am extremely fixed income focused. I do intend to increase my equity allocation, and I've been doing so over the last 3 months, but on a very measured basis, and we'll see where it goes. In terms of time to maturity, I have two-thirds of my portfolio in short-term T-bills that I am going to start rotating out as the yields decrease. And I have a bunch of agency bonds, many of which are getting called. And I'm starting to move into munis and corps based on the yield Super Bowl, as I call it. So let's look at REITs, because this was proposed by one of our listeners who said, hey, you're not looking at REITs. They are just like a bond, and it works very well. So I thought, let me research REITs some more. Before I go any further, I want to make sure you know that I am not a wealth management advisor. This is not investment advice or tax advice. I share my research. You do you. Well, the yield curve started at the bottom, the dark blue line, if you will, in May 2023. And it just went to historic heights. You know, if anybody gave you yields like that today, you would go laughing to the bank. Such is the reality. And you said, or I said, oh, 5% for 5 years and 10 years, that's okay. We'll just look for equities, or we'll stay in the short term because I can get 6%. Greed, my friends, greed. And we just watched that come crashing down. The long tail is pretty much where it was in May 2023, and the short end is starting to come down. You have no idea where the final curve is going to be, but if you're Chairman Powell or the government, you do not want to pay these astronomical interest expenses. You do want to decrease interest rates, so that is coming whether you want it or not. My sweet spot, you may remember from the previous episode, is to focus on longer durations, but I still like my yield. I'm not going to settle for a really low treasury yield, so that yield curve that dips to almost 4%, I am not going to accept that. So I'm going to see what I can do and get there better. And that is where maybe our friend's recommendation on looking at a REIT, maybe that is the right thing to do. So I started researching. I'm going to give you a very elementary, simple way of understanding a REIT. I go buy an apartment building for $100, and I say I'm going to put that in an LLC, and I'm going to issue 1,000 shares in that LLC for 10 cents each. 10 cents times 1,000 is $100, and I start collecting rent. And when I collect the rent, for every share you own, I will give you 1/1000th of the rent, except, it cost me some money to create the LLC, and, I do need to get paid for operating the LLC, so I'll take a little bit of administrative expenses, and more than, the bulk of what rent comes up, I'll give it to you. That is a REIT. And sounds pretty simple, sounds very nice until you start looking at REITs with financing. Because in order to go buy the apartment building, people don't have cash lying around. So it's more like I borrow $10 million. And because I'm borrowing that money, I say, well, I am so confident I'm going to do this in such a good way that I will pay you prime plus 4%. Today, with prime at 5 something percent, prime plus 4 would be 9%. So I borrow $10 million at 9% to build an apartment building. And then I issue shares. Now I issue slightly more shares. And then I'm going to say I'm going to rent that apartment building for oodles and oodles of money. And I'll give you 90% of the income I make. The other 10% are used up in the fund itself. That is a REIT with financing. But there are a couple of caveats to remember. If I borrowed at prime plus 4%, imagine I did that in 2020 and prime was at 0.25%, so this would be a 4.25% loan. As interest rates went from 0.25% to 5.5%, my payments on my interest due went up really, really high. They went up by a factor of 15. So the profitability of the REIT got destroyed. And so I told you I would only share the income left after expenses. Well, interest ate all my income, so I had very little to give to you. Sorry about that. And that has been the reality for REITs in an increasing interest rate environment. And so the share prices have gotten generally hammered. And oh, by the way, I can't suddenly say, oh, I'm going to issue more shares. That's not how a REIT works. So all said and done, REITs have, gotten battered in the first couple of years, with some exceptions, and that's what we'll look at. And there isn't a one size fits all REIT. Some of the REITs want to actually own the real estate. Others will say, not only are we going to own it, we're going to build it and we're going to rent the homes. Others will say, we'll just be the financier. We're going to give money to somebody else and then we'll take, the proceeds from that and we'll give it to you. And there are yet other REITs who say we want to operate it. We want to hire the person who mows the lawn in the condo complex. We want to hire the plumber, the electrician, the pool maintenance person, and they operate that whole area. And each one of these REITs has its own positive and negative consequences. If you own the place and you had to get financing to own the place, we saw what interest rate does to them. If you are renting the units out, when the economy is doing well, your apartments are full. When employment dips, your rental income dips. Let's say you are the financier. Interest rate increases are good because you're lending on a variable basis. However, you do need the borrowing to get paid, otherwise you lose your shirt. If you're the operator, you're hired the pool maintenance person, the electrician, the lawnmower, as they start earning more wages because of inflation, well, that decreases your profits. And if your profits decrease, you cannot give that income to your investors. So there's a lot of, follow through effects in all of these REITs. And the other way of slicing and dicing REITs is to also say, are you in the commercial space? Meaning, are you doing office buildings? Are you in residential? Some of them do industrial, they only do warehouses. Other REITs only lease to the government, and yet others do healthcare, and then there is, a bunch of mixed REITs. And so there are so many different specialized REITs in the market. And so I thought what we would do now is take that bucket of money and start going through and visiting all the REITs around to see who's doing well, why are they doing well, and more. So let's do that. Now, if you were to look at the real estate sector in general and say, how has the sector done? Year to date, that sector is up about 4%. And then there are all these different kinds of REITs, as I told you earlier. And you can kind of see that there are only two kinds of REITs that have done really well. The rest are a drag on performance. And one of them is residential, and the other is healthcare. And oh, by the way, hotel and resort REITs, not a good year for them. I'm sorry to see that. So then I thought, okay, well, we're going to look at the two that are doing very well to see where we can go. And when I say they're doing very well, this is purely based on a stock price. So let's see how they're doing. This is just the healthcare REITs. And you go one level deeper and say of the 1.4 trillion market cap, 150 billion, or give or take 11%, is healthcare REITs. Tell me about the healthcare REITs. And it says, well, the biggest healthcare REIT is almost half the size of the entire market cap. And that has done very, very well in terms of share price. The rest of them have some ups and downs, and they've done pretty well, 18.5% for a year. Remember, my return is 6 something percent. So, hey, it's good to be a healthcare REIT last year. And so I started looking at these REITs and said, you know what I'm going to do? I'm going to understand their fundamentals. Because at the end of the day, I don't chase share price, I look at fundamentals. And so I thought I'd take 5 of the best performing healthcare REITs and do a comparison. So here's what I did. I said, tell me the healthcare REITs that have appreciated the most in the last or in this year to date. And there is one that is 75 million. I'm sorry, Strawberry Fields, you're too small for me to measure along with the $70 billion Welltower. So I'm just going to take the big dogs among healthcare REITs, and I'm going to put them in a stock comparison and see what their fundamentals are. Drum roll, here we go. Top 5 healthcare REITs by performance. These are the ones that are crushing it in the market, and their debt to equity ratio is a little bit high, 130, 125, 98. So if there was any other industry, you'd probably tuck tail and run. But remember, REITs are financed more often than not. And allegedly, a high debt doesn't mean anything because they are going to give a phenomenal return on investment of 1%. Wait a second. That can't be. There is no way you took so much debt and gave me a return on investment on 1%. You may remember our humble TK Tankers is 40%, Cord Energy is 28%, Cal Main Foods is 25%. But something seems to be off here. There must be something else that doesn't meet the eye. These are top performing stocks. So I went into their valuation, PE ratio of 187. Let me think about that. Probably not. Sorry. 46, 28. These put Nvidia to shame here. Forecasted earnings, PE ratio of 9,600. That looks very interesting. So the PE ratios are definitely not in my realm of the world. What about sales? I bet you they are tearing through sales. Sales growth of 10%, 12%. Okay. Earnings. I bet you earnings is where they justify their growth. Earnings per share growth, negative 300%, negative 50%. I suppose Welltower did increase their earnings, but the rest of their fundamentals are not exactly, rosy. Um, Maybe, here's what it is. Maybe they have all the cash in the bank and they're going to pour the dividends out. That, I think, is what it is. So let me look at the dividend coverage ratio. Hold on a second. Every single one of the top 5 performing healthcare REITs have a dividend coverage ratio less than 100. In other words, they do not have the money to sustain their dividends. Interesting. So I thought I must be hunting in the wrong end of the spectrum. Forget about what the stock price says. I keep talking about fundamentals. I am going to set up a filter that says only give me healthcare REITs and residential REITs, because those are the top 2 performing ones, except instead of looking at which stock appreciated, what a terrible way to look at it. I am going to look at profit margins, cash flow, PE ratio, my kind of jam. And when I filtered it and only looked at real estate, REITs, I do find a match. This excites me because I now have one which pretty much meets the Magnificent Seven criteria for yield nerds. So that is Next Point Residential. And so I started digging deeper into Next Point. If it meets the Magnificent Seven criteria, it must be something special. So here is Next Point's 10Q. And I just want to make sure that I'm understanding it, I'm sharing it. So Next Point is a REIT, but the REIT is a subsidiary of this other thing called the operating partnership, or the OP. But the operating partnership also has some VIEs, which are variable interest entities. And then I forgot to tell you, the TRS, which is the taxable REIT, is really the subsidiary. And the OP owns 99% of the portfolio, and the REIT owns 0.1% of the portfolio. You go, what am I buying here again? They go, okay, that's okay. Well, all of this is for tax reasons. There are smart people doing the taxes, and 99.6% of the voting stock is owned by the company. And I suppose you're not here to vote, so don't take these things seriously. It's okay. So I see how it works. There are layers and layers of administration here. And oh, I forgot to mention one more thing. The company itself is not managed by the board of the company. The company is managed externally by this other company called an advisor. And the advisor every year gets paid 1.5% of the income before it comes to you. And the company only has accounting employees. Everything else is, part of somebody else. So the external entity owns all the people, all the resources necessary. The company has accountants, and the advisor, takes advice from the board and the investment committee, and they do a phenomenal job of running the company, I guess. So I understand how that works. Then you start looking into what else is part of this company, and you realize 30% of the portfolio may not even be in this REIT. As a matter of fact, they may buy stock in other REITs, and they may also go buy distressed loans. They go, wait, I thought I was investing in residential apartment buildings. Well, sometimes they may want to buy options and derivatives to give you more income. That's what they are doing. And you go, okay. Let me see how they perform. Maybe that's where the rubber meets the road. Hold on a second. Their revenue is actually going down. I thought this was the wonderfully performing company. So, what is happening to their income? I need you to focus here. Don't look at unnecessary things. Their net income actually is going really, really high. I would think that is phenomenal until you realize their revenue is going down, and the reason the net income is going down is because they are selling their prized possessions. They are selling their real estate. So by selling more of their real estate, they are generating the cash to keep alive. And you then ask the question, why are revenues down in residential rental REITs? And it turns out the market is turning a little bit. To be clear, rents are at an all-time high, and the rents aren't coming down anytime soon. People are just getting, put into longer and longer rental contracts because the people who own the buildings are paying such high interest rates. So it's not exactly a very attractive place to be. My thesis on REITs, I suppose if I have to own REITs because I'm somebody who believes I have to diversify, I have to own two REITs, I have to own two aircraft companies, I have to own two industrials. I suppose if I believed in that, I would buy REITs. I don't believe in diversifying for the purpose of diversifying. REITs seem like a wonderful thing. They finance construction for homes, and I'm always happy to see that. But if I look at the fundamentals, and I don't care about the stock price, if I look at the fundamentals, I do not see that in REITs. What I do see is excellent fundamentals in food, health, energy, and military stocks. And so that's probably where I'm going to be unless a REIT qualifies. But you do you. So here are my trades. And this is my usual. I did buy one more corporate bond. It is a BNSF bond. It is a whole call bond. I bought it at a discount. It pays 4.9% coupon, but because I bought it at a discount, it's more like 5.1% coupon. So we'll see where that goes. A lot of my agency bonds are getting called. Surprise, surprise. The agency doesn't want to keep paying me a high coupon. They would rather call the bond and reissue it at a lower coupon. I do have a new equity buy to report. RCAT and ASC, these are companies that I always have. I did put first money in to a company called ITCI, Intracellular Therapeutics Incorporated, and let me tell you more about them. If you only looked at the share price, it's a Cinderella story. But as I argued earlier, I don't like just looking at a share price and saying, because the share price is going in the right direction, all else is pardoned. That is not how I do it. Let me tell you a little bit more about ICTI. Make sure you do your own research. They have come out with a drug which is FDA approved that treats bipolar and neuro degenerative diseases. The same molecule, the molecule is called lumateperone, that's a mouthful. That molecule has already been commercialized with that dosage, 42 milligrams for one disease, but they are repurposing it to address several other diseases. Four other medications are in the process of going through FDA clearance. And that is what excites me because they don't have to invest more capital to do more research and look at new molecules. They are using the same molecule. And here is the story. Their revenue has been a Cinderella story year over year, fantastic compound growth. Now, if they kept, spreading the money into all kinds of research, revenue would not translate into earnings. Surprise, surprise. Their earnings per share, they used to burn a lot of cash. They are down to burning a very small amount of cash. They have $1 billion in the bank. They are burning 15 million a quarter. And all indications are based on this, they may produce positive earnings per share. Then you have to look at the cash flow and see if truly this is going into cash. And drum roll, their cash balance is they are not burning as much cash at all. And what this tells me, or my hope, is that if one more of their drug gets approved, then they should turn cash flow positive. That is what I am betting on. So here is my portfolio. RCAT is still my leader. I still have healthcare stocks, energy stocks, and food stocks. I don't own anything else. Those are the sectors I plan to stay in. REITs are not for me in the short term. Thank you for watching Yield Nerd.